Welcome. Subscribe to AS Foundation, India's leading academy for CA course, and hit the bell icon to get the latest updates. Thank you.
What is the importance of bonds credit rating? That it is easy to market your bonds, convince the investor, and secondly you can bargain for a lower interest rate. Better the credit rating, lower the interest rate. So if it is a AAA rated bond, normally you will negotiate around 8 to say 8.5% interest. But if it is a AA rated bond, immediately you have to pay, say in this example, 9.5%. And if it is A, then 11 to 12% you will have to pay. So just because your rating is changing from A to AAA, you may save 3 to 4% in the deal. So credit rating company has to be very impartial here, because a bond which should be rated A, if they rate AAA, they are misguiding the investors. Then the whole process of credit rating is a flop show. Okay. But again, as I said, integrity is important in this credit rating business, just like in auditing firm. More about that later, about integrity. Next paragraph, mergers and acquisition. What is our topic right now? Do you remember? Functions of investment banker. So we have covered IPO, follow-on offer, issue of debt. And now the next function, point number 4, 2.4 is mergers and acquisition. How many departments are there in investment banking business? Yesterday we have discussed 5. Which 5? Corporate finance, sales, trading, syndicate research. Okay. Management buyout is not a department here. It is a way you acquire shares. I'll repeat, it is corporate finance, sales, trading, research, syndicate. In that order we have discussed. Now my question is, why I asked you that question? Which department handles mergers and acquisition? Is it corporate finance? Is it sales department? Is it trading, or is it research? So the corporate finance department, research will always back you, but which is the main department on the front? The corporate finance department. 2 activities are the main activities there. One is raising of funds, which we have discussed, shares, follow-on public offer, bonds. And the next important function of this corporate division, corporate finance division, is the M&A activities. They are called M&A experts also. Okay. Not only that, within that sometimes there is a buy side expert and sell side expert also. Merger transaction do not directly involve sales people, traders or research analysts. Although research people may help them to some extent, but they will not be the main people here. Main people are corporate finance department team. M&A advisory falls into the domain of M&A specialist and fits into one of the either 2 buckets. So they are called M&A specialist, because again lot of negotiation, valuation, midnight oil burning is involved here. You will not be able to sleep for many days, continuously negotiate to the point of harassing the other people and being harassed by the other person also. Okay, it's a mind game. It's a It's a mind game. Who can actually survive? Continuously you have to negotiate. No? In a continuous negotiation, who can survive longer is the winner. So they have a different skill altogether. And they can either represent the seller or they can represent the buyer. So when you will go to them, they will ask you first thing, who are you? Are you going to sell your business or are you going to acquire the business? Do you have any target company in mind? So also called target representation and acquirer representation. Sales representation is called target representation and acquirer representation. Buyer is called acquirer. Anyway, don't bother. Next line. In your book there is a table which is not appearing on the screen, so I will read from your book. Representing the target or the seller. Sales side representation comes when a company asks an investment bank to help it to sell a division, plant or a subsidiary operation. That is the meaning of sell. So a client comes to you and he says, please help me to sell a division. I don't want to run this airline business. I am happy with cold drink and beverages and other kind of drinks. But airline business is not my cup of tea. So then what this investment banking will do, they will help you to identify a buyer. Or you want to sell a plant also, for example, or you want to sell a subsidiaries operation. Second point, the work involved in finding a buyer includes. So what are the services iBanker will do? They will write a selling memorandum and then contract potential strategic or financial buyers of the client. Again, all documentation that they have to do. We'll do it, contact them, explain them, negotiate them, convince them, sell it to them. What the acquirers, iBankers do, the advisory work itself is straightforward. The investment bank contracts the firm, their client, who wishes to purchase, attempts to structure a palatable offer for all the parties and make the deal a reality. So it means they will contact the party, the one who wants to sell, the one who is your target company. They will simply say, we want to acquire this company, tell me what is the price, tell me what are the terms and conditions. Sit down, negotiate and finalize the deal. Okay? They are very ruthless sometimes in their activities. They are very ruthless. How? They will tell the management that we want to acquire your company. Just tell me how much you want to sell it for. Management says we are not interested. So they will say, okay, I'll purchase from the market. There are 70% stake with the public. So I'll make a public offer, 50% more than the ongoing market price. And I'll acquire more than 70% or 70% share. Is it right? So all these mental games they will play. Huh? They can do backdoor entry. Yes, that is backdoor entry also they can do. That is what these merger specialists do. Okay, they will threaten you indirectly that we will acquire your share from the market because promoter has only 30% share. So I don't need to depend on you. I am just coming here politely. If you want, we can do the deal. Otherwise, I will have a hostile takeover bid on your company. In India, there is another route also. Which one? Blackmail. We will not discuss that right now in the class. Come to the next paragraph. Deals that get to be done, that do get done, though are a boon for the iBank representing the buyer because of their enormous profitability. So generally such deals bring lot of money, not only to the iBanker but also to the parties involved. Everybody wins. Now we'll discuss the two sides of M&A. Which are the two sides of M&A? Buy side advisory and sell side advisory. These are the two parts of M&A activities. Buy side, as the name suggests, what they are going to do, they are going to help their clients to acquire the target companies. So their advice will involve whether they should acquire a particular target company or not. And once they decide to acquire a target company, then these mergers and acquisition specialist will help in negotiating. Negotiation is an art. One bad thing about CA students is that they are not very good in negotiation. So here they usually hire people from MBA colleges, okay, where they are taught how to negotiate. They are very aggressive. They can even use abusive languages also, just to pressurize. Just to pressurize, okay, the other party. Because then you should be able to speak very ruthlessly also in that meeting. That what kind of company is this? I will not going to pay 10 paise also for this company, just get on. The other party will go into back foot, okay. But then they also need people who can play on the front foot. And after some heated discussion, again they will have a break, again they will come to a polite language and discuss. But these are the tricks that they have to use. Then they will conduct due diligence. You are acquiring a company. Acquiring a company is like finding a groom for your daughter. Okay. Do due diligence. Why you are laughing? All of you are laughing. What your father will do to find a boy or a girl for you is the due diligence. Lot of investment is involved. Financial, emotional, social. Here also lot of investment is involved, but mostly financial. So therefore, before you select the company and pay the money, do due diligence. Due diligence is a detailed audit exercise to see that all the assets are appearing in the balance sheet are genuine. Whatever value you are putting on them are genuine. Liabilities are properly disclosed. All liabilities are disclosed. There are no hidden liabilities or contingent liabilities. You should not end up in some kind of problem at a future date. So that is due diligence. And then financing. They can also help in raising of finance. Like this, Chorus was acquired by Tata Steel. So their M&A company did all this, but they also helped this Tata Steel to raise some thousands of crores of rupees by again negotiating with different bankers. Many bankers were brought together to raise money for acquisition. And then finally, everything needs to be documented. But tomorrow if there is a problem, you have a document. Like in audit we do nowadays, documentation. After 2-3 years, if some fraud occurs in that company, then you should have that documentation ready to prove that we have done the work in the best of my given scope of work. So documentation is to be done, because then the SEBI may ask for document, RBI may ask for documentation, ICI may also ask you, okay, depending upon what has happened. Peer review they can do. In their business, I don't know whether peer review is done or not. Now the question is, what are the 4 steps in buy side advisory? Quickly, shortlisting of companies to be acquired. Shortlisting means, suppose you want to acquire a software company and you find there are 5 or 6 potential companies. So out of 5 or 6, you just first narrow down 1 or 2 or 3, and then in this step the investment banker helps the client to shortlist the companies to be acquired. So just like your dad will bring 10 photographs, and then you will select how many? 2 or 3? Shortlisting. 7 are rejected. Out of 3 now, 1 has to be selected, not more than 1. You will opt for 2. You'll do opposite means 7 out of 10. You will select 9. Okay, right now we are under recording mode, so let us not stretch that further. Come to the next line. In this step, the investment banker helps the client to shortlist the companies to be acquired. Just compare it with a wedding of a girl, and you'll find all the steps are same. To extend this service, it uses its network of relationship with companies, private equity funds, and other intermediaries to identify the suitable companies that are to be acquired. So they take the help of their other group companies, private equity firms, or other intermediaries. So within their news network, they will inform that we need a company like this. They will try to get information about this company. Okay, and then the step number 2, let us say you have completed the first step. Okay, this is the company we want to acquire. Preparing and executing the term sheet. Term sheet we have seen earlier also. In which chapter? Name the chapter. Private equity. Then what is term sheet? A sheet containing terms and conditions. Okay. So it is like a terms and condition agreement copy. So it's a draft copy of all the agreements, all the points. The investment banker prepares term sheet which includes all the terms and conditions of the merger transaction. And it has to be prepared in detail because this will form the basis of further negotiation and the amount that you are going to pay. It then facilitates negotiations with the target company and ensure that the term sheet is entered into by the client with the target company. So that is a challenging task, bringing both the parties to sign the term sheet. They may not agree to this, they may not agree to that, and after days of intense negotiation, you make the two parties sign the term sheet. Okay, so at least now they are preliminary ready to acquire or merge, and then you perform the due diligence. What is due diligence? Due diligence will involve verifying assets and liabilities. You actually physically do the verification of fixed asset, inventory, and you want to check whether debtors are genuine or not, so you will ask for the confirmation. Then you want to ensure all liabilities are shown in the balance sheet. You will ask for the lawyer's records so that in case of any contingent liability, you will get to know about it. Okay. You will see all the legal fees that you have paid during the last 2-3 years. Then you will ask, why do we need to check the legal fees payment document? Because there will be a bill of the lawyer who will say, fees charged for this purpose, fees charged for this purpose. And then you will get to know, oh, this company has this problem. Is it right? So these are due diligence exercise. Identify the risk involved. The risk can be technology risk, finance risk, business risk, government risk, political risk. Knowing the amount of risk involved, identify the risk, and then you have to calculate what is the monetary value of that risk that I am taking, and then protection against such risk. How we can protect ourselves from such risk. This is due diligence. And in case if you think that risk is too much, tata, bye bye. Okay. Yes or no? Yes. After that, suppose the due diligence step is over and you are convinced that okay, now we can buy, then you do the transaction closure. So all the formalities that are required will be done. After the completion of the due diligence process, investment banker negotiates on the final agreement with the target company to close the merger and acquisition deal. So there is a final agreement that will be prepared now. After term sheet, they will prepare a final agreement. Now in some exam I have seen, or in some model test paper, they have asked this question. Steps involved in a buy side advisory is as follows. So they will give you 4 4 options. Which of the steps is right? So what was the first step here? Shortlisting. Second was preparing term sheet. Third was due diligence. And fourth was transaction closure. You can't do transaction closure before due diligence. So if you have understood the concept, you can on your own answer that this is how the thing should move. Is it right? But this is a potential question in the exam. The steps involved in mergers and acquisition deal are this, and you have to arrange in the sequence. I am going to take that question also at the end.
It can also happen that after due diligence we get to know different and then we change the term sheet.
It is possible. This is a basic structure. Okay. After due diligence, many times we don't agree also. Okay. In the due diligence, you find that the boy is a drunkard person. Okay. He drinks a lot, smokes a lot, plays cards every Saturday and Sunday. So you will reject or you will again renegotiate. Reject. Or you will negotiate, no, you will not drink after marriage. He will say yes, but who knows? Future is uncertain. So therefore this is due diligence. Compare this with that and everything is clear. Okay. Sales side advisory. Sales side advisory service means now the investment banker is helping the client to sell his business, division, department, factory, subsidiary, branch, which has some value. Okay. So sales side advisory is also important. And there are firms who have specialized in this activity also. Because selling an asset is also very difficult. Selling a business is very difficult. Air India, they are trying to sell themselves for last so many years. Do you know that? But they are not able to find a buyer. So many times they have given the job to some investment banker, but nobody wants to acquire it. So government says we will only fund it now for the next few more years. Is it right? So sales side is a difficult task because you would want to sell a company or a business only if you think it is not profitable now. Otherwise, why would you sell? And since it is not profitable, why would others buy? And therefore, it is a challenging task. So investment bankers help the client companies in identifying suitable buyers, which may include private companies, public companies, PE funds, hedge funds, and international buyers. Okay. So they ask so many people, like for example, Jet Airways wants to sell their stake. So they are negotiating with some Indian airlines also, Singapore airline also, some Middle East countries based airline also, and then they will negotiate and find out who will give the better price and they will sell. Okay. So sales side advisory is very challenging and they get a lot of fees in this. They are also being divided into 4 steps. What are the 4 steps? First is, again you tick mark and remember the sequence. Preparation of information. If you want to sell something, what do? We prepare a catalog. Of course, here we will not prepare a catalog, but we will make a list of the business that we want to sell. What are the asset, liabilities, income, expense, products, services. So investment banker helps in the preparation of information on the purchasing companies, insert business profile, which helps to present the deal in a structured manner in front of the potential acquirers. So nowadays that is also a skill, preparing a presentation. And some of them, just to prepare that 16-page PPT, charge you lakh of rupees. Huh?
They call it as IM.
They call it?
IM.
Information memorandum. Huh. So they will hire a specialist in just making a PPT. I prepare every day, but this is very simple, just to teach in the class. But their PPT will be containing 8 to 16 slides, not too many, because the other party don't have so much of time and patience. And within that, you have to convince him. So that is called preparation of information. My artist who does some special PPTs for me, he says 500 rupees per slide. If I give them my entire this book, FC, Financial Services and Capital Market, he would have charged me 2-3 lakh rupees in PPTs only. Yes or no? But we don't. This I can do myself. First is information. It's like you make a presentation. Second is you target shortlisting. That means to whom we should approach. To whom we should approach. You can't approach anybody to waste your time. If suppose Jet Airways wants to sell and raise money, where they should go? Where they should go? To whom they should approach? They might approach another airline, because another airline will be more interested. They will not go to a telecom company that please acquire us. They say we are already problem and you want me to acquire an airline company. We don't know anything about that. So they will approach Indigo, they will approach some other US company, Singapore Airline, okay. And then it becomes easier to present your views. So that is called target shortlisting. After going through the client companies extensively and shortlisting of potential buyer, the investment bankers enable the client company choose its partner. As in the case of buy-side advisory services, it uses its network of relationship with companies, private equity funds, and other intermediaries to identify the suitable companies to whom the client company has to be sold. So they will use their network and find out which are the companies to whom this business can be sold, who can be interested in this business. Is it right? What is third step here? Here the third step is preparing and executing the term sheet. In buy-side advisory, it was the second step. Because here one extra step has come. We have to make a presentation on the company that we want to sell. In this step, the investment banker helps his client enter into a term sheet with the potential acquirer. So term sheet will give you a basic idea about terms and conditions. Okay, basic idea about what are the terms and conditions. And then there will be a final agreement. And then you complete the due disclosure, due diligence and deal closure. So maybe in the exam you can put it as separate point. First point is information, shortlisting of target, preparing and executing term sheet, due diligence and deal closure. So 5 steps are involved if you keep them separate. After entering into a term sheet, the investment banker helps the client in the due diligence process. They have not explained it again, same thing, and negotiate with the purchaser to close the deal. So all this may take, it looks very simple, it may take some months, okay, to complete the whole process. Because first binding a proper buyer, proper price, terms, conditions, regulations, okay, it takes time. Now we'll come to private placements. These iBankers also help in private placements. Sir, what is private placement? Here I am not going to raise funds from the public, but I will ask some strategic investor who would be interested without going to the public now. That is private placement. So even iBankers arrange such deals also. They know who are the companies or investors or institutions who will take interest in acquiring some stake in your company. So private placement, which involves selling of debt or equity to private investors, it resembles both a public offer and a merger. It only resembles. Why public offer? Because you are raising funds not from just one person, but a group of persons. Of course, the number of people will be very limited here. It may be 5, 10, 20 investors only. And it is like a merger because you have to do lot of due diligence before you select the party. So it is having some element of public issue and merger, but is neither public issue nor a merger. But some steps are similar. Second, why do companies go for private placement? Of course, to raise the capital. And they don't want to go public. Generally, companies which are new, small, unknown in the market, they will go for private placement. Often firms wishing to go public may be advised by the investment bankers to first do a private placement, as they need to gain critical mass or size to justify an IPO. So the investment banker will say, boss, you are very small right now. Is it right? Your sale is only 3 lakh rupees or 10 crore rupees. Don't go for IPO right now. You will not be getting money, you will not get a good price. Because to go for an IPO, you need to have some critical mass. That means you need to have a sale of say 500 crore, profit of say 15 crore to 20 crore. Then people will show interest. Otherwise will not. They can go to SME. But that is okay. That is for small investors. Small companies, you can go to SME listing also. But you don't get that kind of reputation. Okay. So it's better you invite few people only, less headache. But sometimes few people can give you more headache also. They are usually the province of small companies aiming to ultimately go public. So either you can use private placement route. Time required is very less here. You have to deal with few people. Formalities are less. You get more money. The process of raising private equity or debt changes only slightly from a public deal. What is the difference between private placement and public issue? Name some differences. So first difference is private placement do not require any security to be registered with stock exchange. Good. Lot of time and energy saved there. And of course, sometimes you have to give money also, which is saved. Don't write that. Second, it does not involve a huge elaborate roadshow of 10-15 days. You can just meet the investor in a single day and then take the decision. Because this time involved and money involved in roadshow is very expensive. You have to visit different countries, different cities, okay, have major conferences. Private placement involve a firm selling stock or equity to private investor rather than to public investors. So these are the 3 differences here. 2 more differences below. In place of prospectus, the I-banks draft a detailed private placement memorandum, which in the subsequent discussion we will call PPM, Private Placement Memorandum. If you go to take a job in an investment banking company, they can ask you a simple straight question. What is PPM? Private Placement Memorandum. It is usually for private placement purpose when you are not raising funds from the public. So it is like a prospectus only, but not the prospectus in the legal sense. Like a prospectus, because ultimately you have to tell your investor that this is our company, this is our profit, this is our sales, blah blah blah. A typical private placement deal is smaller than public transaction. Next difference, size. Private placement deal is smaller. Private placement deal is smaller, public issue is very large. Next difference, private placement involves selling equity and debt to a single or few buyers, whereas in public issue you have to sell it to large number of buyers, which can run into lakhs of investors. The investor and the seller typically negotiate the terms of the deal. So it's like one-to-one negotiation between the company and the investor. There are few investors only. You just have to draft PPM instead of a detailed prospectus. Time involved is less, cost involved is less, issue size is smaller. So that is the private placement. And instead of roadshow, companies looking to sell private stock or debt will host potential investor as interest arises and give presentation. So they will not conduct the elaborate road shows, but still there will be a meeting with the potential investor. There will be a meeting and you will explain them the company's profile and give presentation, convince them. So what is the role of investment banker here? Investment banker work involved in private placement is quite similar to sell side M&A representation. As a company, I am a small company, my business is to manufacture steel. I don't know how to deal with investors. I simply appoint an I banker, he will identify 3-4 good investor and he will negotiate on my behalf and close the deal. Okay, and he will charge me some fees for that. The bankers attempt to find a buyer by writing the PPM and then contacting potential strategic or financial buyers of the client. So this is the role of I bankers. They will write PPM, make presentation, contact the potential buyers, sellers, negotiate, close the deal. Okay. Investment banker function as negotiator for the company, helping to convince the investor of the value of the firm. That is the role. In private placement also they do the same thing. Negotiation, convincing, closing the deal. Fees involved in private placement work like those in public offering. Normally they get a percentage, okay. Usually they are a fixed percentage of the size of the transaction. How much you can negotiate depends, 1, 2, 3%. Okay. Now we will continue tomorrow.